The market mood has turned defensive, so could utilities come back into fashion? The S&P 500 has wiped out most of its gains for this year after some weak economic data, including retail sales and business activity, added to nervous sentiment among investors. The US administration is also planning large-scale layoffs, adding to worries that consumers may rein in their spending. More defensive sectors are gaining ground, though. Utilities are up more than 4% on the year. Well, Matt Miskin is co-chief investment strategist at John Hancock Investment Management. Matt, you nominated utilities as a good defensive bet. Why?
We're seeing them actually trade relatively cheap, so they're trading at a 20% discount relative to the overall S&P 500. They've got strong earnings growth. They actually just had double-digit earnings growth in Q4. They're forecasted to have high earnings growth, high single-digit earnings growth into 2025. And then they pay nearly a 3% dividend. So you can get paid to wait as more volatility could be creeping into this market.
Now, clearly their earnings are fairly stable because the consumer doesn't have a choice not to pay their energy bills. But in choosing this, are you then expecting a widespread consumer pullback in more discretionary spending?
We're seeing more modest spending. The consumer really post the election went through a spending spree. That is starting to now show up as the reversal of that. In more business activity across the world, frankly, we're seeing that. There was a pull through of trying to get ahead of the tariffs, and now we're seeing this air pocket. Well, as this air pocket presents itself, more defensive parts of the equity market are providing leadership, and utilities are more defensive. To your point, they actually provide an inflation hedge because they can actually raise prices pretty easily, and they're more almost like monopolies. So that is actually one of the other benefits here. Is it's a bit of an inflation hedge, and it is defensive if consumers do turn away from more discretionary spending.
Utilities, though, have seen an enormous shift in recent years as they move to green energy and need to increase their electricity transmission capacity. They've invested heavily in infrastructure. Might the new administration's desire to cut back on federal funding and support for anything green create problems for them?
It is a potential headwind, but what you're also seeing on the other side is there's massive power demand for AI. Artificial intelligence requires much more computing power. And what we're seeing is just massive investment in data centers and things like that. And they need to run on energy. And so what we're seeing is massive investment on the other side to increase power output. So that should mitigate some of that. And then also we need to diversify our power resources across alternatives just so that we're not concentrated on one thing. So it's probably not going to mitigate too much, and that other kicker of greater power demand should offset that and actually help.
Is it possible that as the Chinese apparently lower cost DeepSeek model showed, that AI might not actually need all the power that they're currently investing for?
We are seeing cheaper options or lower resource intensive options be created. That is part of technology. It always evolves and tries to do things faster and better. But what we're also seeing is there's greater volume of demand. So even though there are cheaper options to create AI, the AI demand is actually accelerating at a parabolic rate. And so even though the AI trade is wobbling a bit on the DeepSeek kind of competition, what we are seeing is the AI demand hasn't slowed. If anything, it keeps going. So that is another risk. But what we are seeing is demand is still up. Electricity usage is still up. And then, by the way, earnings are only forecasted for high single digits, which should be fine. You get a 3% dividend. The stocks act more defensive. There's other things that can work out for you beyond that.
How does this sector differ, Matt, in Europe versus the US? Because in Europe, of course, we've seen very volatile energy prices, particularly around natural gas for geopolitical reasons, the conflict in Ukraine, which has created some problems for utility providers because the prices have been so volatile.
It's actually one of the bright spots in Europe. Some of them are global, so they're domiciled in Europe, but they're global. They actually own some of the US utility segments here. But what we're seeing is those companies pay even a better dividend yield. There is some volatility around natural gas prices, energy prices, but at the same time, the utility provider just passes on the pricing. So they're not necessarily negatively impacted by that. And going back to our early part of the conversations about inflation, if inflation does manifest itself through the energy complex, those utility providers actually usually get a bit of a benefit because they're pricing on those higher prices. So we don't think it's that bad, actually. And again, if there's volatility around geopolitical risk, utilities will offer some defense. That's something that's maybe a bit underappreciated right now in the space.
That was Matt Miskin of John Hancock Investment Management. Don't forget, you can watch more videos on Reuters.com.